But in Fed speak, saying nothing is still saying something. And what they said this time through their press release, dot plot, and public remarks is that they're still worried about inflation and not quite ready to start cutting rates. They also signaled that if inflation continues to cool and the job market doesn't overheat, they could still cut rates twice by the end of this year. That's the plan, at least. Not a promise. Now, if you're a normal human who doesn't read FOMC meeting minutes for fun, weird flex, but okay, you might be wondering, wait, does the Fed even control mortgage rates? Short answer, no. Real answer, not directly, but their decisions heavily influence them. Here's how it works. The federal funds rate is the interest rate banks charge each other for overnight loans. Mortgage rates, on the other hand, are tied to longer-term borrowing, especially the 10-year Treasury yield, which reacts to what investors think the Fed will do next. So when the Fed says we're staying put for now, the mortgage market rates are going to stay where they are for longer, and investors adjust their expectations accordingly. That's why you didn't see mortgage rates drop after the June meeting, because while the Fed did not raise rates, they also didn't give markets a strong enough reason to believe cuts are right around the corner. In fact, some investors are now betting we might only get one cut this year, and some are even thinking we might not get any at all. So no, the Fed does not pull the mortgage rate lever, but they do control the mood of the room, and right now the vibe is cautiously tight.